I'm about to show you a mistake that costs beginner investors an average of $47,000 over 10 years. And it happens in the first 30 days. Most people think investing starts with buying stocks. It doesn't. There's something you need to do first, and if you skip it, you'll join the 78% of investors who panic sell during their first market crash. Here's what's wild. The people making the most money right now aren't the ones who started earliest. They're the ones who avoided 3 specific traps that wipe out portfolios before they even get started. I'm going to walk you through all 3 in this video. But first, let me tell you what happened when I ignored this advice. I put $5,000 into the market. Felt like a genius for 6 weeks. Then December hit. Market dropped 20%. I panicked. Sold everything. Locked in a $900 loss. If I'd just left it alone, that $5,000 would be worth over $12,000 today. I learned the hard way. You don't have to. By the end of this video, you'll know exactly where to put your first dollar, which account to open first, and the psychological trick that stops you from sabotaging yourself when the market crashes. No fluff. No theory. Just the exact system I'd use if I were starting over today. Starting in 3, 2, 1. Here's what's different about this approach. We're not starting where most investing videos start. Because the first thing you invest in isn't a stock. It's protection against yourself. Let me explain what I mean. 120 to 250. Step 1. Get your financial house in order. Pop quiz. What's the number 1 reason people sell their investments at a loss? It's not market crashes. It's emergencies. Car breaks down. Medical bill hits. Furnace dies in January. Suddenly, you need $2,000 you don't have. Your investments are down 10%. But you have no choice. You sell. You eat the loss. You swear you'll get back in when things stabilize. You never do. This is why the emergency fund isn't optional. It's the foundation everything else is built on. 3 to 6 months of expenses. In cash. Boring. Safe. Accessible. Not invested. Not in crypto. Not working for you. Just sitting there, doing the most important job in your financial life. Keeping you from making desperate decisions. Here's what most YouTubers won't tell you. This step is more important than picking the right stocks. Because the best investment strategy in the world falls apart the moment you're forced to sell at the worst possible time. Now here's the second piece, high-interest debt. If you're paying 22% on a credit card, that's a guaranteed 22% loss every year. The stock market might give you 10% if you're lucky. You're bleeding 12% before you even start. Think about that. You could pick perfect stocks and still lose money because your debt is erasing your gains. So here's the controversial take. If you have high-interest debt and no emergency fund, you're not ready to invest yet. I know that's not what you want to hear, but it's the truth. Kill the debt. Build the fund. Then invest from a position of strength. Because investing without this foundation isn't brave. It's reckless. And the market punishes reckless. Here's a question that will completely change how you invest. When do you need this money? Because most people skip this step. They just start buying stocks and hoping for the best. But here's the problem. If you're investing for retirement in 30 years, you can afford to ride out crashes. If you're saving for a house down payment in 2 years, you can't. Same activity. Completely different risk profiles. This is why just invest in index funds isn't always the right answer. The right answer depends on your timeline. Anything you need in less than 5 years? Keep it safe. High-yield savings. Short-term bonds. Stuff that won't vanish when you need it. But long-term money? That's where the stock market makes sense. Here's why. Over any 20-year period in history, the stock market has never lost money. But over any 1-year period, it's lost money 26% of the time. So your timeline isn't just a detail. It's the entire strategy. Most people lose money in investing because they're using a 30-year strategy for a 3-year goal. Don't be most people. Write down what you're investing for. Put a number on it. Put a date on it. Then design your portfolio around that reality, not around what's trending on Twitter. Okay, here's where most people leave thousands of dollars on the table. They invest in the wrong account first. Let me show you what I mean. 2 investors. Both put in $10,000. Both earn 10% per year for 30 years. Investor A uses a regular brokerage account. Investor B uses a tax-advantaged retirement account. 30 years later, Investor A has about $152,000 after taxes. Investor B has $174,000. Same money, same returns, $22,000 difference. That's the power of tax-advantaged accounts. In the US, that's a 401k or IRA. UK has ISAs. Canada has TFSAs. Australia has superannuation. Every country gives you a way to invest where the government doesn't take a cut of your growth. And yet most people ignore this and go straight to Robinhood or whatever app is trending. Here's the move. Before you invest a single dollar in a regular account, max out your tax-advantaged space. Because this isn't just smart. It's free money. The government is literally saying, invest here and we won't tax your gains. And people still ignore it. Don't be that person. In 2026, contribution limits are higher than they've ever been. Use them. This is the only guaranteed return you'll ever get in investing. Keeping more of what you earn. Take it. All right, we're finally at the part everyone thinks is investing. What to actually buy. And here's where beginners blow themselves up. They think they need to find the next Amazon, the next Tesla, the next crypto that 100x's. But here's the truth. You're not smarter than the market. Neither am I. Neither are most professional fund managers. In fact, over 90% of professional investors fail to beat a simple index fund over 15 years. These are people with MBAs, teams of analysts, and million-dollar Bloomberg terminals. And they lose to a boring index fund. So what chance do you have picking individual stocks? I'm not saying it's impossible. I'm saying it's unlikely. Here's the better strategy. Own everything. Low-cost index funds let you buy the entire stock market in one purchase. One share, and you own a piece of thousands of companies. Some will fail. Some will explode. You don't know which is which. But when you own all of them, it doesn't matter. The winners carry the losers. And the whole thing trends up over time. This is what Warren Buffett recommends for most people. And he's worth $120 billion. Now, stocks aren't the only piece. Bonds add stability. They don't grow as fast, but they cushion the crashes. Real estate funds diversify you even further. The exact mix depends on two things: your age and your risk tolerance. Younger? You can afford more stocks. You've got 30 years to recover from a crash. Older? You need more bonds. You can't afford to lose 40% 2 years before retirement. Here's a simple rule. Your age in bonds, the rest in stocks. 25 years old, 25% bonds, 75% stocks. 50 years old, 50/50ths. It's not perfect, but it's better than guessing. And here's what's beautiful about this. You don't need to be smart. You don't need to watch CNBC. You don't need to stress over earnings reports. You just own the market and let capitalism do its thing. Boring? Yes. Effective? Historically, yes. And that's all that matters. Let's address the question that keeps people from starting. Should I wait for a crash? Everyone asks this. And here's the problem. You have no idea when the crash is coming. Neither does anyone else. The market might drop 30% tomorrow, or it might climb 50% over the next 2 years. If you wait for the perfect moment, you'll wait forever. So here's what you do instead: dollar cost averaging. Fancy term. Simple concept. You invest a fixed amount on a regular schedule. Every week. Every 2 weeks. Every month. Market's high? You buy a little. Market crashes? You buy a lot more. Over time, this averages out your cost. You stop worrying about timing because you're always buying. And here's the psychological benefit. It removes FOMO and panic from the equation. You're not trying to outsmart the market. You're just showing up consistently. Because here's the secret. The people who get rich investing aren't the smartest. They're the most consistent. The market rewards discipline, not genius. So automate it. Set up automatic transfers from your checking account to your investment account. Treat it like a bill, non-negotiable. And then stop checking your portfolio every day. Because the less you tinker, the more you make. That's not a metaphor. That's a proven fact. The best performing investors in one study? The ones who forgot they had accounts. They couldn't panic sell, so they won by accident. Be boring. Be consistent. Get rich. Here's the part that separates winners from losers. How you behave when the market crashes. Not if, when, because it will crash. Maybe this year. Maybe next. Doesn't matter. And when it does, your brain will scream at you to sell everything. That's biology. Your amygdala sees red numbers and thinks you're being chased by a tiger. But here's the reality. A market crash is not a loss. It's only a loss if you sell. Let me say that again. You don't lose money unless you sell. Every crash in history has been followed by a recovery. Every single one. 2008, recovered. 2020, recovered in 6 months. Dot-com bubble, took longer, but it recovered. The people who lost everything weren't the ones who stayed invested. They were the ones who panicked at the bottom and sold. So here's the mental shift you need to make. Short-term volatility is the price you pay for long-term growth. You can't have one without the other. If you want 10% annual returns, you have to accept 30% drops along the way. That's the deal. Take it or leave it. And here's what helps. Stop checking your portfolio every day. Set it. Forget it. Check it once a quarter, maybe twice a year. Because the more you look, the more you'll be tempted to do something. And in investing, doing nothing is usually the right move. Here's something subtle that most people miss. Your portfolio changes shape over time. You start with 70% stocks, 30% bonds. Stocks go on a run. Now you're 85% stocks without realizing it. Feels great, right? Everything's growing. But you just took on way more risk than you planned for. And if the market crashes tomorrow, you're going to feel it harder than you expected. This is where rebalancing comes in. Once or twice a year, check your allocation. If it's drifted too far from your target, adjust it. Sell some of the stuff that's grown. Buy more of what hasn't. This sounds backwards. You're selling your winners. But here's why it works. It forces you to buy low and sell high. When stocks are expensive and everyone's euphoric, you're trimming them back. When they're cheap and everyone's panicking, you're buying more. You're being disciplined when everyone else is emotional. And over time, that's how you win. This isn't complicated. You're just maintaining the plan you set. But most people skip this step, and they end up taking way more risk than they can handle. Don't be most people. Final step, and it never stops. Stay curious. Investing isn't something you figure out once and coast on forever. The economy changes. Your goals change. New strategies emerge. So keep learning. Read books. Listen to podcasts. Follow people who've actually built wealth, not people trying to sell you courses. Because the more you understand, the less scary it becomes. You stop falling for hype. You stop panicking at headlines. You see the patterns. You understand the game. And that clarity is worth more than any stock tip you'll ever get. The best investors aren't the smartest. They're the most informed and the most patient. Be both. Here's your roadmap. Build your emergency fund and kill high-interest debt. Define your goals with real timelines. Max out tax-advantaged accounts. Diversify with low-cost index funds. Dollar-cost average to kill timing anxiety. Control your emotions during crashes. Rebalance to manage risk. Keep learning forever. 8 steps. No shortcuts. No hacks. Just the proven path that's worked for decades. You're not behind. You're exactly where you need to be. Now execute. If this was valuable, smash the like button and subscribe for more real investing content. Comment below. Which step are you executing first? Let's build wealth the right way.